Warren Ingram, you're taking this fight thing quite literally. I mean, you smell of deep heat. You're glowing because you've been warming up outside the studio. You're taking this very, very seriously. The basis of our discussion.
Game one.
Okay, no, that's fine. Basis of the discussion. Explain your premise, please, as to why you've chosen to bring the war to this studio tonight.
So, I mean, firstly, I'm not really a fund manager groupie. You know, I'm quite wary of fund managers and especially following their individual comments and their individual picks. I think there's some very eloquent fund managers that can speak brilliantly about markets and economies. And then when you look at how they actually deliver returns in the real world with real money, the eloquence isn't quite matched by delivery. But what I do like to do is track, some of the better fund managers, and just see over time, or in a short space of time, I should say, what they're talking about and what they're looking ahead at. So not really about a prediction, but I use them almost as a barometer. And when you look at the bigger, more well-respected fund managers that I like and respect, you get a good sense of where they think, whether they think there's value in markets, whether they think there's trouble ahead, and then as an investor, from my perspective, looking at that, I start to get either a sense of growing concern or a sense of increasing comfort. And for the first time, pretty much since about 2014, 2015, I'm going from deep concern to increasing comfort and perhaps a little bit of excitement, so much so that I can take on the famous Bruce Whitfield in a battle.
Okay, so what is the basis of your position this evening? Because asset managers, they go through their reporting periods, and they either say we're happy, we're sad, and they do like the financial equivalent of a market emoji. And right now, more fund managers than have in the last 5 years are beginning to say things look positive.
Yeah, and they're not making predictions. What they're looking at is they're saying we're starting to find value in South African incorporated businesses, SA Inc. businesses. In other words, companies that make most of their money in South Africa from doing business with South African individuals or companies. And that's something that they have not said for a very long time. So what it means is that they are looking at the price that these companies are trading at the moment. They're looking at the profits that these companies are making, and they're looking at the revenue and saying to themselves, well, their revenue has been declining for probably 4 or 5 years, a lot of these companies. So the management teams have been cutting their own cost base. They've been making themselves leaner and meaner. And they've got to the point now where they are as lean and as mean as they possibly can be and still survive and still function. And so any kind of positive movement from here in the economy is likely to translate into a much bigger than expected profit for these companies, because their revenue is going to go up, but their cost base is now very low. And that to me is a very common sense way of looking at things. And it doesn't mean that these fund managers are forecasting that the economy is suddenly going to grow at 5% a year and we're going to absorb major, unemployment into the economy now. That's not needed for the cost base that these companies already have. They have already been positioned for a declining economy and for a recession. So when the economy just starts to grow at 0.8 or 1%, for example, that's a heck of a lot better than it has been for them for quite some time, and that's the trigger that these fund managers are looking at.
At the same time, there are some brutal realities. I'm just going to throw a couple of these at you, shall I? The one is electricity prices. Now, you take money out of my pocket, I've got less money to spend, I've got less money to invest. So not only am I spending less, I'm then the companies in which I would like to invest are then getting less revenue from me, and I've got less money to invest anyway, and that creates quite a hostile and negative, toxic environment towards investment.
True. And I think that's that's kind of the present. That's where we are today, right now. And if we look at all these commissions that we've got that are showing us how bad things have been, that's the rear view mirror. What we need to remember is we don't drive a car, at 120 kilometers an hour, focusing on the meter in front of us or the 200, 300, 400 meters behind us. What we have to do is look 2, 3, 4, 500 meters ahead of us. And that's what investing is all about, is investors need to look forward to say, where am I likely to get a return on my capital? So the current environment is a lot of the time you'll hear fund managers talk about things being in the price. This is already priced in. And I think that, fund managers, the decent ones have quite some time ago put into their pricing already, Eskom pushing up prices. They might have put in double digit increases and it looks like nurses saying just below double digit and then declining rates of increase thereafter. And the important thing about companies is that they tend to adapt to these environments that they're in already, and they tend to kind of move forward. It's not a static piece of granite that just deals with environment without change.
Okay, so you dodged the pothole. We're going towards the oil slick now. That oil slick is the noise around nationalisation of the Reserve Bank, for example. Now, I believe that this whole thing is a bloomin' red herring. I don't care who owns the Reserve Bank, provided that the governor and the deputy governors of the Reserve Bank are left alone to do the job of managing inflation. And that is their job. And so far, so good in terms of them being left alone to do so. I think the president will be politically expedient and say, yeah, sure, we'll nationalise the Reserve Bank. Go ahead and do it, and we'll carry on as we normally do. But it's the messaging that it sends, that this is a country on the brink that is now messing with the sovereignty and the integrity and the independence of the Reserve Bank, which just is not helpful.
100% agreed. I think you can add two more pieces of unhelpful news to that. That would be, land expropriation, especially without compensation, and then the whole thing around free higher education and where do we get the money for that. So again, those are real concerns. Those are real issues, and I'm not for one moment saying that we don't have big problems, but remember we need to understand what's already in the price of the investments that are trading in our stock market. So what's in the price of the bond market and the property market and the share market.
How do we know what is in the price? Because if all of the stuff was in the price, including the possibility of a looming downgrade as a result of Eskom's debt burden and the fact that we spend more than we earn and the fact that the National Treasury is being treated like a piggy bank that's had the lid screwed off, that's a very real risk. And I can't for the life of me assume that all of this stuff is priced in. These are multiple
right.
and diverse threats.
No, you're 100% right. So I think things like the nationalization of the Reserve Bank, that would be in the price because what's not being discussed in any way, shape or form is changing the mandate of the Reserve Bank. All we're talking about here is a kind of a really archaic ownership structure that has zero impact on how the Reserve Bank is run. And I think any savvy investor is looking at this and saying, if you're an international investor, you would look at this and say, let me spend 15 minutes, which is probably all that's required to understand who votes, for whatever happens in the business of the Reserve Bank, and then who votes to decide what the mandate of the Reserve Bank is. And as we know, the mandate is dictated actually in the Constitution, and that it's driven from the Constitution down. It's not driven by these shareholders. They have zero impact on running the actual business of the Reserve Bank, and I think the debate around the Reserve Bank's mandate is a healthy one to have, not nationalizing it. That's unhealthy and it's unwelcome and unnecessary. But all it is a kind of as you said, it's kind of giving candy to the populists to make them feel better they won something.
Yeah, again, you start tinkering with institutions of state, and so today we demand nationalization of the Reserve Bank. Tomorrow we demand that judges stop wearing wigs. And the next day we say judges must stop, prosecuting, must stop jailing people for committing commercial crimes. At what point do we stop interfering? We agree. And now the latest one, and it's something we discussed here a couple of weeks ago, Treasury confirming that it does want to tax the offshore earnings of South Africans. And the risk here is that anyone who can may very well choose to do financial immigration and cut ties with South Africa, and yet another generation of skills and talent and taxpayers leave, and that undermines growth and opportunities for a turnaround. I'm sorry to be the Grinch on this one, Warren, but for all of the optimism, positivity in this, fund managers say that they see 12 to 15% growth over the next 5 years. I'm wondering if they're driving in the same car on the same road that I'm driving down, where the streetlights don't work.
Okay, so I'm going to address it in two ways, because I think the one is a valid issue, and it's a valid concern, and then we've got to bring out the joker. This taxation is, again, it's completely unnecessary, and just something that I think it will generate some tax revenue, but what we are going to do is drive the most in-demand workers in the world that come from South Africa away from South Africa, and ensure that they never come back. So it's a stupid policy. I don't know why they're doing it. It's not going to generate tons and tons of revenue, and a little bit of economic growth would resolve this issue much more quickly than trying to tax the people that are in demand around the world. What we need to do is encourage them to come back, and
then tax them.
Simply
and then tax them when they come home, which is far more reasonable.
And tax them fairly, and let them grow our economy, and let them grow businesses here. So what's the joker in the pack? The joker in the pack is that when interest rates in America stop rising, and we might be there already, and when Trump stops his trade wars with China, and that's coming because Trump needs a deal, right? He's got an election around the corner, and he needs to land something, because he's kind of losing pretty much everywhere. So when that deal lands, then suddenly global investors have a bit more appetite for risk, which means that they will start to buy emerging markets. And then we need to understand how emerging markets are bought. So there will be, and he's probably 27, and it's almost certainly a he, sitting in the corner of a massive trading floor, either in New York or in London, and his job is to buy emerging markets when the strategy team has made a committee decision, and the committee says, yeah, okay, it's time for a bit of risk on, and we allocate 5% of our billions, if not trillions, to emerging markets, and then this youngster just gets an instruction to buy. He has no idea where South Africa is, let alone what's going on in the South African economy. He just simply buys on instruction and buys en masse. And that's what happens. That's what happens when they sell and when they buy. They don't really look at the stuff in detail.
Which is all well and good if we've got an investment grade that says investment, tech. And if we're not, then we go to the bottom of that emerging markets list.
The bond market, certainly that's a big issue. But I think on the equity market, it'll be less of an issue.
Warren, I think we've reached stalemate, and that's a good, positive place to be. I want to believe the asset managers. I want to believe that this market can double in value over 5 years, because I need to believe it can double over 5 years. There's an awful lot of catching up that we need to do as an investing public in South Africa.
Cyril Ramaphosa may have had...
you see, and now he's invading our space.
Cyril needs us as well.
He needs us. But I just feel quite apprehensive, and I think it then comes from, I suppose, a place of being bruised and battered, and wanting to believe that things will improve, but being quite fearful.
Can I have one last word?
Of course. That was the open-ended opportunity for you to close off without me beating you.
I appreciate it. So I think we're there, and I think we, as an investment population, there are many people in South Africa that have been investing for the first time that have never really received growth above inflation from their share investments, which is probably only 6 times in our history since 1900 that's happened over a 5-year period. And the message there is, don't capitulate, don't act, en masse, because that's human beings. We're at our worst when we get together in the biggest groups, because I think the rationality here is important to understand. These are really vibrant companies in South Africa, managed by really top management most of the time, and they've adapted to the environment that we're in now, and they will generate profit again. They are paid to generate profit, so they will. And that's really the point here. We don't need miracles. The country needs miracles, but from an investment point of view, we don't need major miracles to start making money from here. And that's my key message is,
Can I direct you to a conversation I've had with somebody that is completely the opposite of what we've had this evening? Yes, you've been Mr. Positive and I've been Mr. Grinch. But I had an interview which has been broadcast on ENCA at 10:30 this evening, and I don't mean to punt the TV show ahead of the radio. Sorry, program manager. Bad
Everybody.
Bruce. Suspend myself again. 1, 2, 3. At 10:30, Greg Solomon, the chief executive of McDonald's in South Africa, growing close to double digits, in some cases double digits, opening stores, investing money in this economy because they see opportunity, and it's a really important conversation. We'll get Greg on the radio to talk about it soon as well. So yes, I do remain the positive bunny, but I thought you should be challenged. Warren Ingram from Galileo Capital.